Before we move on to talking about our basic financial statements, I want to summarize the business transactions. Figure 1-1 on page 25 in your book summarizes all the transactions that ran through the chapter starting on page 20 and that ran through page 24. So take a good look at this chart on page 25 and make sure you understand it, because your homework exercise problem 1-2A will look just like this when you get it finished, but with different transactions and different amounts. But it will help you with problem 1-2A, so make sure you understand it. So there are certain rules that apply in business transactions. A transaction that increases total assets must also increase total liabilities or owner's equity in order for the accounting equation to remain in balance. A transaction that decreases total assets must also decrease total liabilities or owner's equity. Some transactions increase one asset and decrease another, like a shift in assets. But regardless of the effects of a transaction, the accounting equation must remain in balance at all times. On page 26 in your book, figure 1-2 is a little chart of transactions that affect owner's equity. It shows you that owner's equity is increased by owner investments and revenue and decreased by owner withdrawals and expenses. So if you learn these rules now, it's going to make it much easier for you to learn about financial statements and for you to learn about debits and credits in Chapter 2. So financial statements are summaries of financial activities. They're used to communicate the accounting information to the users, and there's three types: the income statement, the statement of owner's equity, and the balance sheet. The financial statements are prepared on a regular basis at the end of the accounting period. An accounting period is typically 1 year, but it could be any length of time depending on how the business wants to do it. The minimum length is usually 1 month and the max length is 1 year. So the income statement contains information about a business's revenue and expenses for a specific period of time, usually 1 month or a year. The statement of owner's equity is a summary of changes in the owner's equity during a specific period of time, a month or a year. And a balance sheet is a listing of the firm's assets, liabilities, and owner's equity at a specific point in time, such as the last day of a month or the last day of a year. So it's like a snapshot of the business at any one point in time. So make sure you understand that the income statement shows the firm's revenue and expenses. The statement of owner's equity shows the owner's equity accounts, and the balance sheet shows shows assets, liabilities, and owner's equity. On the income statement, if you have more revenue than you have expenses, you have a net income. If you have more expenses than you have revenue, you have a net loss. Just like with you and I and our personal checkbook, if we have more money than we have bills, then we've got a net increase, and if we've got more bills than money, we're in the red. We got a net decrease. You see an example of the income statement, statement of owner's equity, and balance sheet on page 28 in your book, and this will help you with exercise problem 1-4A in your homework.